I'm back. Did you guys miss me? I've got 3 stocks that I think are buys right now and lower. Of course, the market right now, we're in a little bit of a sell-off. And there are a lot of macro risks, a lot of geopolitical risks. We've been talking about the last couple of videos. More headlines this morning. Consumer sentiment dips amid rising inflation and student loan payments. We've talked about how student loans coming back into play, how that could impact the consumer. 68% of GDP is consumer spending. So to combat inflation, the Fed's raising rates. As rates go up, mortgage rates go up, mortgage payments are higher, rent payments are higher, student loan payments come back into play, consumers have less money to spend, less disposable income to spend. And Fitch back in the news. Fitch warns it may be forced to downgrade multiple banks, including JP Morgan. All these things are going to impact sentiment. You're also in a seasonally weak period for the stock market. You had a massive rally, especially in technology, the first half of the year. And so what happens next? Well, right now we're seeing some more pressure. We're seeing some more selling. So I've identified 3 stocks that I like right here, especially if you're a long-term investor. Of course, with any of these stocks, they can go lower. So I'm going to give you some price targets, some price ranges to look for. Now, the first stock is Tesla. It's at $232.96 right now. Now, it's down about 20% in the past month. Year to date, it still is up 115%, but over the past year, it's still down 24%. And this isn't a dirt cheap stock. PE ratio is about a 66. This is 12 months trailing. Market cap is $729 billion. Of course, this was a $1 trillion market cap at one point, and it will be back in that $1 trillion club with time. 52-week low got down to $101.81. 52-week high, $314.67. So some recent news today. Tesla launches cheaper Model S and X versions in the US with shorter ranges. The new S and X standard range models are priced at $78,490 and $88,490 respectively. So this new Model S has a range of up to 320 miles. That's less than the current Plaid variants of 405 miles and 396 miles respectively. Model X SUV has a range of up to 269 miles, well below its more expensive versions that offer 348 miles. So we've talked a lot about Tesla on this channel, and we've talked about really how if you want to expand electric vehicles and make them really nationwide in the US has to have more charging stations. You need longer range batteries. Now, with that said, the vast majority of people live in cities, and if you're buying a Tesla really to just drive to work, you're not driving it cross country, you might not need that longer range. Now, what I think is really interesting about this is you're getting the exact same car. It's just that software locks it. It basically has a governor on it. So Tesla's confirmed that its new standard range Model S and X have the same battery pack as the long range version. So you're still getting the same high quality product. The software is just capping the mileage range, which you may not need. This top comment here, this is a great deal. Most of the time, you're only supposed to fill your battery 80 to 90%. People with the larger battery end up normally getting between 324 to 365 miles per charge. Of course, they have the option of filling it to 100%, but with this person's 2018 Model S, we rarely fill it to 100%. Why not get $10,000 off for using your battery the same way you normally would? Now, of course, the flip side of this, when you look at it from an analyst perspective, you're lowering the prices. That's going to impact margins. And margins, as we talked about before in the channel, that's really the primary differentiator when you think of Tesla versus its primary competition. So it's always this push-pull dynamic. Yeah, you're lowering prices, you might sell more cars, but what about the margins? That's your primary competitive advantage. And I've talked about this before as well, but you think of the Apple ecosystem. You know, you've got an iPhone, you've got an iPad, you've got an iMac, you've got Apple this, Apple that, Apple CarPlay. Tesla's really building an ecosystem as it sells more cars, as it expands its charging network, as more competitors use their charging network as the standard, as more products roll out like the Tesla Cybertruck, the semi-truck, and more. Tesla's in the early innings of building out an ecosystem, and I think there's a long way to run. So I'm thinking of this as a 5-year type of investment, long-term investment. And of course, you've got crazy price targets out there. You've got Ron Barron, saying it'll be a $1,500 stock by 2030. You got Kathy Wood, $2,000 stock by 2027. Now, a lot of the reason that ARK is bullish on Tesla is robo-taxis, and we haven't really scratched the surface on that yet. And there's other moonshots out there, like you think of Optimus the robot. There's lots of opportunity longer term for this company. So let's look at the valuation metrics for Tesla. Then I'll also share a chart, and I'll show you some target areas where I'd be buying the stock. Now, this first chart here is going to be your price to sales ratio. It goes all the way back to 2020, and you can see it is slightly higher than 2020, but it's a different company than it was 3 years ago. And you can see at the peak, it got way up here, 30 price to sales. Right now, it's about 8.6. So not as low as we saw at the beginning of 2023 when it was closer to $100 a share. But, if you look historically, it's still fairly attractive. Now, that's not cheap by any means. Let's look at some other metrics. So let's look at a forward price to sales ratio. Now it's a 5.74. The PE ratio, this is a 12 months trailing, 65.99. Now, if we look at the forward PE ratio, this orange here, it's 47.39. Still not dirt cheap. Again, you're looking at accumulating shares, hopefully at cheaper prices. And I'm going to show you some of those prices here on a chart in a second, but holding this stock for 5 years. Now, this is an interesting chart because it's showing you the revenue, the TTM revenue. You can see this has ramped up all the way to $94 billion. And so if you're buying the stock here and the PE ratio is out of this world on a different stratosphere, you can see that you're overpaying for the stock. And this has come down. This PE ratio has dropped off a cliff, but at the same time, this revenue is climbing the other direction. Something important to add here now, the orange here is going to show you the revenue growth estimate for current fiscal year. And you can see that's come down closer to 23%. So even though that revenue TTM is scaling up nicely, the growth has slowed down some. Of course, some of that's going to be from the economy. And that's part of the reason that Tesla has been lowering prices to sell more vehicles as well. And there's also tax credits to put into consideration and other variables. And so if we go into recession, certainly a stock like Tesla will be further impacted and the price is going to go lower. Now we do chart day every single Wednesday morning at 9 o'clock a.m. Eastern live in Patreon Discord. When you see orange, that's a previous chart day. Yellow is going to be today's chart day. Now, if you look at some of this previous commentary, we like this stock, especially $150 or less DCA and Discord. Most of us were buying pretty heavy in those levels. The stock got up to $300 and it's pulled back. So of course the stock is still way off of the lows. When you look at that 101, 81 low that we had here early January, post-market, the stock's at $232.13. Now I switched this into orange because this is last week's chart day. And I said last week, the downside possibilities are 228, 214, 202, and 188. So you can see this first line here. This is going to be your S3. These are Fibonacci pivot points. You can see this first line. It's getting pretty close to that. That's going to be around $228. Now this trend line here is going to put you closer to the circle. And these are moving averages. So you've got the 50-day moving average, the 100-day moving average in red, and the 200-day simple moving average here in the purple. If you get down to that 200-day moving average, it's also on that trend line. It's going to take you to the previous S2. And so I think it's possible you see something like that closer to $200 a share. This would put you at $198 a share. And this previous S3 is down here at 168. For me, if this stock gets below $200 a share, I think that's kind of an area that I would try to load up some shares on Tesla. And that might not happen. So if you really like the stock, I think your first point's going to be below 230 and you're going to dollar cost average really in this range. Now that previous S3 is all the way down here at $143. So it's certainly possible that the stock could get to $150, especially if the whole market rolls over. But I'm looking at this, if I buy the stock at $225 in 5 years, am I going to make money on that? And the answer, in my opinion, is yes. So this is really going to be up to you. If you think you can time it, if you think it's going to go lower, you certainly wait. For me, I like the dollar cost average, just nibble a little bit at different levels, and I'm thinking long term when I'm buying. Now, Amazon recently reported earnings. It was a solid earnings report. I've been telling you for a while, I'm bullish on Amazon. There's a lot of reasons why. And I've done a lot of deeper dive videos on Amazon. I think people get bored, they get lost in the weeds. But the thing about Amazon, guys, it's a mega cap conglomerate. If you look at Tesla, we just talked about, that's going to be a green energy conglomerate. Amazon's going to be a technology conglomerate that has its hands in so many different pots. The primary reason I own Amazon, it's not because of retail. It's not because of Kuiper satellite, even though I think that is an exciting part of the business. Really, I own it for Amazon Web Services. And if you think about the advertising segment, that has been absolutely a beast. And just looking at some of the earnings highlights that I posted in Discord, Amazon Web Services, $22.1 billion versus $21.8 billion. Advertising, $10.7 billion versus $10.4 billion. Now, if you look just at Alphabet Google and you look at YouTube, specifically YouTube, that returned to growth in this last quarter with ad revenue up about 4% year over year. And that was at $7.7 billion. And again, Amazon advertising advertising just came in at $10.7 billion. So Amazon advertising is now nearly 40% larger than YouTube advertising. And a quote here from Andy Jassy, CEO, our AWS growth stabilized as consumers started shifting from cost optimization to new workload deployment. And when asked about generative AI, Jassy said it's going to be at the heart of what we do. So when you look at Amazon Web Services, it's not just public cloud services. You're talking about actually building hardware, building chips as a fabless semiconductor company to build chips for AI in their servers. You also have things like quantum computing to look forward to in the future, but looking specifically at enterprise AI, so Bedrock, Amazon Bedrock, that's going to be something that's scalable to existing customers. Now, Amazon Web Services is the king of cloud. So as they roll this out, they're going to be able to expand that within their existing footprint. And I've been telling you about Bedrock for months. I did a video months ago, didn't get a ton of views, talked about Bedrock. Now it's starting to get the attention of analysts. I'm very bullish on Amazon long-term for many, many reasons. And if you want more information about Amazon, there's several videos in the channel that go much deeper. So same deal, let's look at some valuation metrics and then a chart. So this is price to sales ratio for Amazon, 2.646. And of course, again, it's not going to be the cheapest we've seen it because we saw a lot of these stocks at lower levels here at the end of 2022 and the beginning of 2023. But if I look back going all the way to 2019, it's the lowest it's been from a PS ratio. Forward 1 year price to sales, 2.236. PE ratio, 108.43. Now that's not cheap, but you can see it was just 300. And this last earnings report made it drop from 300 to 108. So you can see if a company is growing, if they're performing, they can grow into those valuations rather quickly. And that's the key. It has to have growth. It has to have some sort of catalyst. This has a catalyst with AI. Now, if I look at that forward 1 year PE ratio, 46.45, still not dirt cheap, but getting more attractive. And if you look at revenue, similar to what we saw in Tesla, where that's going up, 538.05 billion. Now we look at revenue growth estimate for current fiscal year in the orange. Now that fell off a cliff. I think it's bottomed and it's starting to head the other direction. The market's forward looking. You can see the market starts to buy the stock in anticipation for those earnings reports to start coming in more positively. Now, of course, same deal with Amazon. If we go into a recession, the stock's going to go lower and it could retest those $100 levels again. And unfortunately, I don't have a crystal ball to say, hey, we are going to go into a recession. We're not going to a recession. Don't buy stocks, buy stocks. What I can do is look at a company and say, hey, will this be a good investment if I buy at these levels and I'm thinking 5 years out? And I think Amazon fits that bill. So recently on chart day, I said 125 support. This is before earnings. I prefer 115 to 120 between these two red lines. Now it's possible that it comes down to here, but right now, if you're looking at the chart, post-market, $137.69. Many analysts have turned more bullish on this stock and it's making it go higher. I'm not necessarily saying I go out and buy it hand over fist right here at $137 a share. I'm saying if the market continues to roll over, there's pressure. If the NASDAQ continues to sell off, all these stocks are going to sell off. This is going to be a larger component of some of those indexes like the S&P 500 and the NASDAQ. And if you look at the 50-day moving average, this is closer to 130. This 100-day moving average is about $118, $119. This 200-day moving average is 106. I don't necessarily think it's going to go to $106. If it does get back close to $100, that's a pound the table for me personally. But I do think it's possible you could see this, $125 to $130 and the sweet spot, especially if it came down between these two lines here and this 100-day moving average, closer to $120 a share. Now I've got one more stock pick, and I think this is a diamond in the rough. This is a hidden gem. It's got explosive growth. Wait till you see the numbers on this. This has better growth than Celsius and Snowflake and a ton of other stocks that you might think are hyper growth. Before I do that, if you're new here, subscribe to the channel, click that bell for notifications. I'm trying to get this channel to over 50,000 subscribers. We're so close. You can help me out by subscribing today. And if this video is helpful, drop me a like and drop me a comment. And I need to announce that this video is sponsored by the Motley Fool. If you'd like to see the 10 best stocks to buy now, visit fool.com/firedupwealth. You can also join our private community, Patreon Discord, by visiting patreon.com/firedupwealth. You can see all of my buys in real time, as well as the members from the community in the investing trade floor. Go check it out. Now, this last stock is a small cap, and this was a SPAC, and I believe that's the reason why nobody wants to touch it really with a 10-foot pole, it seems. The company's firing on all cylinders. The numbers are solid. And if I look at this and I just say, if this isn't a buy, I don't know what is. And I could be wrong. Maybe this company is going to go out of business. Who knows? But I look at this stock and say, if there were one stock right now that just doesn't seem to make sense, when I look at the valuation and I look at the growth, it's this this next stock? You know, for INDI Semiconductor, you're talking about this recent earnings report here just on August 10th. Q2 revenue, $52.1 million, up 102% year over year and 29% sequentially. So people say, well, the growth is slowing down. Wait till you see the valuation metrics, though. Secured a large program win at Bosch. And there were a couple deals that got pushed a little bit. And this is a company that's not profitable. And they're saying, hey, we're going to be profitable soon. And the market's saying, hey, I don't really believe you. Guides Q3 2023 revenue up 100% year over year and 15% sequentially. Now, of course, with any company, if you're growing at 100% quarter after quarter, it's going to be hard to just keep growing at 100% for infinity and beyond. This is a $240 million annualized run rate. And I did interview the CEO on this channel. You can go check that video out after this video. Reiterates plan to reach non-GAAP operating income in Q4, more than double revenue in 2023. Okay, well, it's non-GAAP operating income and it's not guaranteed, and it was a SPAC. When the market has uncertainty, it's going to sell small caps, it's going to sell anything that's burning cash, anything that has higher risk of default or not going to work out. You know, if these companies that have higher risk of going out of business, the market's going to throw them in the trash can anytime the market rolls over. As soon as the market goes bullish, stocks like this are going to shoot up again, assuming they can continue to produce solid numbers. Price to sales ratio, 6.05. Forward price to sales ratio, 1 year, 2.93. Revenue TTM, 155.6 million. That's a nice curve upwards. Now going back to price to sales, this is the cheapest you could buy this stock since it came public through SPAC back in 2021. At one point, this was 40 price to sales. Now it's about a 6. And again, that forward 1 year, 2.93. So adding that revenue back in, that blue line, 155.6 million. Now that green line is going to give you revenue growth estimate for current fiscal year. And you can see that's down, but it's still 104%. Now, if I plug in Celsius, I plug in Snowflake, CrowdStrike, all those other stocks that we talk about, none of them are even close to 104%. And just to prove to you what I'm talking about, INDI is in the purple here, 104.2%. Celsius is close at 83.18%, but these other ones are not even in the same ballpark. You're looking at 28% here for Axon, CrowdStrike at 35%, Snowflake at 33%, and so on. And again, this is revenue growth estimate for current fiscal year. But it's interesting to look at this and say, INDI Semiconductor out of all these stocks is going to be the highest growth, but yet if you look at valuation metrics, it's not that expensive. In fact, the only one that's going to be cheaper is going to be Mercado Libre at 5.429. Those margins are pretty low though, but you can see here 5.4 for Mercado Libre. You've got Axon closer to 11. You've got INDI here at 6.05, and then you go to Snowflake at 21.4 on the price to sales ratio. So pretty attractive valuation, one of the cheapest levels you can buy it with the best metrics it's had since it went public as well. You know, still growing at 100% year over year. I don't know. You tell me what's wrong with any semiconductor. I think it's a buy. Let me show you a chart. So recent chart day, we said earnings are going to decide what happens next. Earnings on August 10th. And we had a huge range here. You look at these Fibonacci pivot points between 1179 on the top end to 753 on the S3. Now this fell way below that. In fact, it got down in the sixes. It got closer to like $6.50 on Friday. It's recovered a little bit. It's at $7.25 right now. And for us in Discord, I mean, we're buying this stock, especially in the 5s and 6s, and it's really always been something like if you can get it $7 or less, that's a DCA buy. You can see previous chart day, DCA under 7, $5 always possible later. You can see here DCA under 7, $5 possible later, and it did actually get in those 5s for a brief period, and then it kind of rocketed from those levels. You can see here it got down in January. It was a $5.66 stock, and it ripped from $5 to $11. So you look at this, it's going to be volatile. It's a small cap. It has risks. It's probably a spec stock. It was also a SPAC. A lot of people just throw those in the trash. I think INDI Semiconductor in the 6s. For me, it's a pound the table buy as a spec play. Spec play means it's a 10x or 0. But if I look at spec plays out there, if I look at the growth, I look at the metrics, I look at the possibility, interviewed the CEO on the channel. I've done all the due diligence I possibly can on this company. I have conviction in this stock. It's the highest conviction spec stock that I own. And if it's in the 6s, I think it's a pound the table buy. Unless something catastrophic happens with the story, I see this stock being worth a lot more in the next 3, 4, and 5 years. If you're not familiar with what INDI Semiconductor does, I have deeper dive videos on the channel. It's really focused on automotive semiconductors. It's a fabulous semiconductor equipment company. If you're new here, make sure you subscribe to the channel. Click that bell for notifications. Drop me a like, drop me a comment. Have a great rest of your day. Take care.